Gold just surged to another all-time high. The internet blew up. Gold bugs emerged from their basements. People started talking about buying physical gold, gold ETFs, gold coins from that shady ad that plays before every YouTube video. And hardly any of them paused to ask the one question that really matters. Who owns the mines? Here's the thing about gold. No one in the financial media is telling you. Owning gold, the metal, and owning a gold mine are two very different bets. One is a store of value. The other is a leveraged operating business with explosives, diesel, and a water table problem. If the gold price doubles, your coin also doubles. If you own the mine and the price of gold doubles, you can make 5 times your money. Or you might lose everything too, because the costs doubled and the geology turned out wrong. The gold mining industry is one of the most consistently misunderstood businesses in finance. People think it's simple. You dig gold, you sell gold, you make money. No, it's not that. Today we are going into what it actually costs to own and run a gold mine, how the money flows, why the biggest mining companies in the world hedge their own gold production in ways that actually hurts them when prices rise, and who in this whole ecosystem always makes money no matter what gold does. Subscribe to my channel. If traditional financial media gives you a simplified version of everything, I'll give you the full picture. Now, let's start with the physical reality, because that soon puts things in perspective. A modern-day gold mine on a large scale is not like the movies. There's no pickaxe-wielding guy in a candlelit tunnel finding a glittering vein. The majority of gold that is mined today comes from massive open-pit mines. These are holes in the ground that are several miles across and half a mile deep with fleets of trucks, as big as 2-story buildings, driving around in spiral loops 24 hours a day, hauling ore to a processing facility. The Bingham Canyon mine in Utah has been in operation since 1906 and is the largest man-made excavation in the world. You can see it from outer space. It is a byproduct of gold production. Copper is its principal product. It normally takes between 10 and 20 years and costs anywhere from $500 million to several billion dollars to find a mineable deposit, get the permits, build the mine, and produce the first ounce of gold before any 1 ounce is sold. The timeline for the development is what breaks people. Today, a junior mining company discovers a gold deposit. If they're lucky, and the geology is kind to them, and the permitting goes smoothly, which almost never happens, then they may be producing gold by 2035. That's 10 years of burning cash, no revenue, raising capital all the time, diluting shareholders and praying the price of gold doesn't collapse before they turn the switch. Most junior miners don't make it there. They drill. They find something interesting. They run out of money. They get bought by a larger company at a discount, or they just quietly go away. The failure rate for venture capital in mining is roughly the same as the failure rate for venture capital in tech startups, which is to say, dire. Except the ones that survive are sitting on something you can't make physically. In gold mining, the measure that separates the men from the boys is called all-in sustaining cost, or AISC. That's the total price to produce 1 ounce of gold: mining, processing, overhead, sustaining capital, royalties, byproduct credits, the whole 9 yards. It's the figure that lets you know if a mine is really making money at a given gold price, or if it's just pretending to. The global average AISC for gold mining in 2024 was around $1,300, $1,400 per ounce. Gold is trading around $2,300 to $2,500 an ounce through much of the year. The margin looks healthy, $900 to $1,000 an ounce. Some companies were literally printing cash. That's real money. But AISC is an average. There is a huge variation between individual mines. Some operations get gold for less than $800 an ounce. Others are nearer to $2,000. A mine with an AISC of 2,000 inches, a gold market of $2,200 is barely in the black. The same mine is losing $1,800 per market. And gold prices swing. That's kind of the point of gold. Gold averaged about $1,800 an ounce in 2022. By 2024, it was nearing $2,400. That swing of $600 is the difference between a so-so year and a record year for a well-run operation. For an expensive operation, The difference is between survival and a round of rescue financing. Neither are operating costs steady. A gold mine's primary inputs are diesel fuel, electricity, labor, steel, and cyanide. Literally what they use to dissolve gold out of rock. And yes, it's as scary as it sounds. Higher commodity prices mean higher mining costs. The 2021 to 2022 energy price surge hit miners hard, pushing the AISC up across the industry just as gold prices were softening. You can have a good asset and have a bad year because the cost of owning it went against you. The more you learn about how this stuff really works, the less you trust the headlines. Subscribe, we dive deeper every week. Now here's the one that really gets me. Many gold mining companies hedge their production. This implies that they sell gold forward. That is to say, they enter into contracts today to deliver gold in the future at a price fixed today. It is the logic of risk management. If you borrow $2 billion to build a mine, and the price of gold tanks before you can pay it back, you're done. The hedge locks in your revenue and secures the project economics. The problem isn't when gold prices fall, it's when they rise. Barrick Gold, one of the world's biggest gold miners, came into the 2000s with a huge hedge book, forward sales of more than 20 million ounces at prices well below where gold was headed. But as gold went from $300 an ounce to $1,000 an ounce over the decade, Barrick was locked into contracts to sell a large portion of its output at the old hedged prices. The gold price went to the moon, and they couldn't go all in. They lost billions of dollars by closing out that hedge book. Ironically, the hedging problem created a new dynamism. When gold prices rise sharply, unhedged miners see their profits expand dramatically, because every dollar of gold price increase above their AISC flows straight to the bottom line. A mine making 500,000 ounces a year with a $1,000 margin makes $500 million. That same mine with a $1,500 margin, because gold went up $500, makes $750 million. That's 50% more profit for a 22% higher gold price. And the operating leverage is real, which is why mining stocks are often up 2 or 3 times the percentage move in gold itself. All right, and here is the part that's going to bug you. The mining companies are not the most consistently profitable players in the gold mining ecosystem. That's the streaming companies and the royalties. And once you know what they do, you will have a hard time thinking about the sector any other way. A royalty company doesn't mine anything. They lend money to miners, usually at the beginning when the miner needs cash and cannot easily get it from banks, for the opportunity to buy a percentage of that mine's future gold output at a fixed price below the market price. Forever. Or they buy a royalty, a cut of revenue from every ounce the mine produces for the life of the mine. The royalty company has an almost absurdly lean cost structure. No mining tools, no diesel bills, no personnel, no environmental liability. 4. No geological risk after deal closes. If the mine underperforms on gold production, that is the miner's problem, not theirs. They get their cut. They pay some analysts and some deal people, and they wait. This is the model that wins in the long cycle. The miner takes the geological risk, the operating risk, the political risk. The royalty company took those risks once, up front, when they wrote the check. They're a landlord after that. Very patient landlord, very well paid, no employees, no machinery to break down. When gold prices go up and everyone is talking gold, the conversation almost inevitably turns to the metal itself. Buy coins, buy ETFs, buy a gold miner maybe, as they are leveraged to the price. Almost no one mentions that the most boring iteration of this trade, simply being the entity that gets a percentage of production from every mine you've ever financed, forever, without ever touching a shovel or barrel of diesel, has quietly outperformed most of the flashier alternatives over time. That's no guarantee. Royalty companies can make bad deals. They've paid too much royalties on mines that aren't performing. There is no risk-free. But there is a pattern here that you see in every sector we have covered on this channel. The people who are paid to move the thing, store the thing, or process the thing, not own the thing itself, tend to do better in the long run than the people taking the big operational swings. The pipelines beat up on the oil drillers. The port operators beat the shipping companies. The royalty companies outperformed the miners. Subscribe, and I'll continue to show you what mega infrastructure projects are really like.